In today's video, we're going over the tax-efficient ways that you can be charitable. When the Trump tax cuts took effect, the standard deduction was increased to the point that a lot of people were no longer able to itemize their deductions, and therefore they couldn't write off all their charitable giving in some cases. Are there other ways that you can be charitable and take the tax benefit from it? That's what we're going to go over coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a better retirement. If you want individualized help, go to christycapital.com and click on Talk to an Advisor. Today we're talking about tax-efficient ways to give. Now, the first way you can do it is through a 529 education savings plan. Anyone, including grandparents, can contribute up to $17,000 per year or $34,000 for married couples to any individual's 529 plan in 2023. Now, many states offer state income tax deductions if you contribute within your own state, so you may want to check that out as well. Also, something unique to 529 plans is that the federal tax code allows you to front load and give up to 5 times the annual gift tax exclusions in a single year. That means if you're single, you could give $85,000 per recipient, and married couples could give $170,000 per recipient in 2023. Another way you can give charitably and get a tax break is if you're 70 and a half years old or over, you can do what's called a qualified charitable distribution, or a QCD. This is when you donate money to a church or charity straight from your IRA, and it does not come from your checking account first. It goes straight to the church or charity of your choice. If you're 70 and a half years old or over, the IRS lets you do up to $100,000 per person in an annual QCD. What's great about this is that you can still take the standard deduction and write off the charitable amount if you do it through a qualified charitable distribution. The income that you would have normally generated by taking an IRA distribution does not count as a taxable distribution when it goes straight to the church or charity. Make sure you're working with a qualified accountant or financial planner to help you get this done. The only caveat here is that you have to be 70 and a half years old or over. Now, there are some planning ideas in a lot of our videos where we're talking about shifting money to Roth. And so some people may want to do all of their money to Roth and not have any traditional IRA. But if you're charitably minded and you're already given to charity, you may want to leave some money in your traditional IRA because that allows you the option of doing this qualified charitable distribution. Another thing you can do is give away highly appreciated stock. If you have a non-qualified, meaning like not a retirement account, but just a regular account where you own stock or mutual funds that just have a very low cost basis, you can gift that to a family member that's in a lower tax bracket, and they'll have to pay the taxes at the lower rate, or you can give it to charity and they can sell it and they'll have no capital gains at all. Another thing you can do is use a donor advised fund. Maybe if you've got a very high capital gain tax year, such as you sold a business, you have the ability to donate funds to a donor advised fund and then make the gifts to qualified charities from that fund each year. If you plan on giving a certain amount each year, that's where you can kind of front load the gift to take advantage of the deduction in a high tax year. You should definitely look into using a professional to help you if you're going to be using a donor advised fund, just to make sure you do it correctly. If you're worried about taxes, another video you should check out is TSP tax planning, some costly tax assumptions that you don't want to make. If you need individualized help, go to christycapital.com and click Talk to an Advisor. We would love to help you. My name is Mel Stubbs. I'll see you on the next video.